So what is risk? So risk is a slippery and elusive concept, but it's basically the risk is the actual the harm that's going to happen to you. So even just getting out of bed and walking down the road, there is risk there. Getting into a car, there is risk there. There are simple, easy things you can do to reduce risk. So take the car example. You can put on a seatbelt, which will reduce your risk, but you will still get the same gains. Or you can get your car checked out. So this is risk in everyday life. So investing risk. It comes down to the two main types of investing risk. So it's volatility, so the ups and downs of the market, and then inflation. So inflation is the erosion of the pound in your pocket. So if you think back to the cost of a chocolate bar in the 1970s, it's worth, the pound in your pocket will get much less of a chocolate bar in the 70s than it would today. Housing is a great example of the rise of housing and how much you get. If you bought your house in the 70s, the pound in your pocket would get you much more in the 70s than you would get today. So risk is volatility, so the ups and downs of the market is the risk, and then the inflation is the pound in your pocket. So with these forces, I think of inflation like the forces of nature is like the wind if you go out sailing. So quite often you don't realise the breeze just walking out, but also people don't realise how much inflation is eroding their pound in their pocket. They think they're being really safe by having an investment just in a bank, not getting any returns on their any growth or any interest, but actually that's over a 20-year period, that money sat in the bank is going to get eroded over time, and actually that is just having your money in cash is actually really risky, because over a 20-year period you're actually going to lose more than if you'd invested into other assets like stock market or property or commodities. So for instance, the inflation being like the wind, the ups and downs are like the waves of if you go sailing, the ups and downs of the market. So they can sometimes, like the ups and downs of the market, if you're on a ship, it can cause you to get queasy or to get sick, like the ups and downs, but you have to have a long-term plan and understand that there's always ups and downs, like in the ups and downs of the waves, there's always ups and downs of the markets, but by doing simple things, like paying yourself first, diversifying, and then rebalancing, that you can reduce the risk that you're taking, and that's really great for long-term wealth creation and building that wealth long-term.